Good afternoon, everybody, and thank you for joining us today at the Money Marketeers virtual event today, December 1st at 3 p.m. We are extremely lucky today to have Lorie Logan speaking to our organization. By way of some just quick housekeeping, we are the Money Marketeers of NYU. We are a philanthropic organization with the express cause of raising awareness and funding for scholarships for students focused on finance and economics for the NYU Stern School of Business. We were incorporated in 1946, and we continue on that prideful tradition. Ultimately, we would have these kind of events in New York City. Due to Corona times, obviously, we're now in the virtual space. But nonetheless, the goal of these types of events is to bring both market participants and the leaders of markets together in somewhat of an intimate setting where we can hear directly from their perspective what's happening and their thoughts, as well as provide our membership the opportunity to have a conversation and a two-way flow. And with that in regard, I'll just do a quick introduction for Ms. Logan, whose reputation really precedes herself. Ms. Logan is the Executive Vice President of the Markets Group of the Federal Reserve Bank of New York. She is manager of the SOMA system, which is the System Open Market Account for the Federal Open Market Committee. And she is head of the Market Operations Monitoring and Analysis, MOMA. Ms. Logan's responsibility include the execution of monetary policy at the direction of the FOMC, provision of fiscal agent services to the U.S. Treasury Department in support of debt issuance and foreign exchange operations, analysis of global financial market developments, and production of reference rates, including the Secured Overnight Finance Rate, SOFR. Ms. Logan has played a prominent role in the development and implementation of the Federal Reserve's crisis-era policies, including the expansion of the Federal Reserve's balance sheet and the creation of liquidity facilities to mitigate systemic risks to the financial system. She was instrumental in the development of the Federal Reserve's policy normalization tools, including the establishment of the overnight reverse repo facility and the long-run monetary policy implementation framework. And that is quite extensive. Ms. Logan joined the New York Fed in June 1999, where she has held successive leadership roles, and she holds a bachelor's degree in political science from Davidson College and a master's degree in public administration from Columbia University. And without much further ado, it is my distinct honor and pleasure to introduce Ms. Logan. Ms. Logan, the floor is yours.
Thank you. Thank you very much for that introduction, and to Money Marketeers for inviting me to speak with you today. For nearly 75 years, the Money Marketeers has been an essential forum for discussing critical issues related to money markets central to the Federal Reserve's policy implementation and vital to the flow of credit. I'm pleased that the group is continuing to meet virtually in these challenging times, allowing this important dialogue to continue. When I last spoke with this group in April 2019, I discussed the FOMC's recent decision to maintain an ample reserves regime as its long-run implementation framework. At the time, I noted two key benefits the FOMC considered in choosing this implementation framework. First, it provides effective control over short-term interest rates in a broad range of environments, including periods when large amounts of liquidity are needed to relieve stress in the financial system, or large-scale asset purchases are required to support the U.S. economy. And second, from an operational perspective, I noted that a steady-state ample reserves regime can be simple and efficient to operate. As manager of the System Open Market Account, I lead the open market trading desk in implementing policy at the direction of the FOMC. Until earlier this year, our focus was on transitioning to a steady-state ample reserves regime, consistent with the FOMC's decision. However, in March, the global financial system experienced an extraordinary shock, triggered by the coronavirus pandemic, and our focus shifted rapidly. The Federal Reserve took swift and decisive action to address the shift in the economic outlook and deteriorating financial market conditions. The FOMC cut the target range close to zero and directed the desk to conduct repo operations and purchases of treasuries and agency MBS to support market functioning. The Fed undertook a wide range of additional steps, many of them in coordination with the U.S. Treasury to support the flow of credit, and we coordinated with our foreign central bank counterparts to stabilize dollar funding conditions. Regulations were also temporarily adjusted to encourage bank lending. These measures, alongside swift and forceful fiscal policy actions, succeeded in stabilizing financial markets and averted an even deeper collapse in economic activity. Although the pandemic shock was unprecedented, the response that it required, a rapid increase in assets and expansion of liquidity, were the type of actions the FOMC contemplated when choosing an ample reserves regime. And as expected, the shift to operating at much higher reserve levels has been smooth, allowing the FOMC to focus on supporting the flow of credit to US households and businesses. Today, I'd like to talk about this shift to higher reserve levels through the lens of a few key questions. First, how has the historic increase in reserves affected money markets? Second, where might money market rates go from here? And third, how will the Fed's tools work to maintain interest rate control in this environment? In addressing these questions, I hope to leave you as confident as I am that the Federal Reserve's framework is well suited to implement policy in the current environment. To set the stage, let me start with the changes in the Fed's balance sheet since March. As shown in Figure 1, the Fed's balance sheet grew at a historic pace between March and June. Most of the increase resulted from purchases of Treasury securities and agency MBS, shown here in dark and light blue. Expanded repo operations and central bank liquidity swaps, as well as 13(3) credit and liquidity facilities, shown in gray, also contributed to this growth. More recently, the rate of growth in the balance sheet has slowed, with market functioning significantly improved, outstanding balances and funding operations, and many of the credit and liquidity facilities have gradually declined, while the pace of net Treasury and agency MBS purchases has been steady since June. When the Fed expands its assets, reserves in the banking system mechanically increase. For example, when the desk purchases securities from dealers, the Federal Reserve funds these purchases by crediting the reserve accounts of dealers' custodian banks. As shown in dark blue in Figure 2, reserves in the banking system grew rapidly during the spring and are now around $3 trillion, exceeding the prior peak in reserves in 2014. In addition to supplying reserves to the banking system, the Fed maintains an account for the US government, known as the Treasury General Account, as well as accounts for other domestic and foreign official entities. Increases in the balances of these accounts reduce the level of banking system reserves. For example, when investors purchase Treasury debt, funds are transferred from their bank accounts to the TGA. As shown in Figure 2, the TGA has risen dramatically since March, as the Treasury built cash balances to prepare for potentially unprecedented outflows related to the pandemic response. Now, the TGA currently stands at $1.5 trillion, nearly 4 times its largest pre-2020 size. This balance is generally expected to fall in coming months, although the extent of the decline is uncertain. Currency in circulation is another liability that affects the level of reserves. The pandemic increased the public's demand for currency, likely for precautionary and transactional purposes. Growth in the TGA, in currency, and other non-reserve liabilities has muted the growth in reserves since March. In fact, reserve balances would have been about $1.6 trillion higher had these other liabilities remained unchanged. In effect, this increase in non-reserve liabilities has broadened the funding of the expansion in Federal Reserve assets beyond reserves held by the banking system. Before I move on to the key questions, I want to highlight one other Federal Reserve liability, the overnight reverse repo, or overnight RRP, which currently has no outstanding balance. Unlike other non-reserve liabilities, the overnight RRP is used directly as a tool in the Fed's operating framework to ensure effective interest rate control. A broad range of money market participants can invest in the overnight RRP at a fixed rate, placing a floor under overnight rates. So first, how has the historic increase in reserves affected money markets? To highlight how reserve supply influences money market rates, Figure 3 shows a stylized depiction of the relationship between the overnight interest rate and banks' demand for reserves. Now, prior to the global financial crisis, we operated a regime in which just enough reserves were supplied to meet banks' reserve requirements and payment needs. In this environment, depicted by the figure on the left, the marginal bank borrowed at rates well above the interest rate earned on reserves, which at the time was 0, to ensure sufficient balances were maintained to cover payment needs. In an ample reserves framework, reserves are instead supplied in a way that leaves most banks with reserve balances above what they need for payments purposes. As a result, many banks are comfortable investing excess balances when the return on other high-quality liquid assets is above IOER, and also taking deposits at rates near IOER. Now, in effect, IOER sets a benchmark for short-term lending and borrowing. This environment is represented by the part of the reserve demand curve that flattens out with rates near IOER in the figure shown on the right. However, when reserves are supplied well beyond what banks require for payments purposes, many may perceive greater balance sheet costs associated with taking on additional reserves. Now, in this environment, the marginal bank borrows at overnight rates below IOER, as they require additional compensation to grow their balance sheets further. We might consider reserves at this point to be an abundant supply. Even when reserves are abundant, IOER retains its strong influence on rates, although Fed funds and many other overnight money market rates trade at a spread below IOER. So where are we currently on this graphic? As I described, the supply of reserves has been shifting to the right along this curve. Given this, we may have expected money market rates to be lower relative to IOER than they currently are, reflecting an abundance of reserves. However, as shown in figure 4, the Fed's funds rate is much closer to IOER than it was when reserves were at similar levels back in 2014. I'd highlight 2 contributing factors for this tighter relationship. First, banks' reserve management practices appear to have shifted since March. Figure 5 shows federal funds rates relative to IOER at different levels of aggregate reserves over the last 10 years, with observations this year shown by the light and dark red dots. Since March, rates have been higher relative to IOER during the previous periods of elevated reserves in 2014 to 2015, shown by the light blue dots. Some of the light red dots represents observations during the highly uncertain days of March, when some banks paid elevated rates to maintain precautionary reserve balances in the face of extraordinary customer demand for liquidity. To better understand this dynamic, we included new questions in the most recent Senior Financial Officer Survey of commercial banks that collectively hold around 3/4 of the reserves in the system. Banks that increased their reserve balances from February to April confirmed a strong desire to hold precautionary liquidity against potential customer credit line draws or deposit outflows drove the increase. Interestingly, even as elevated market uncertainty has receded and reserve levels have continued to increase, rates have remained near IOER, as indicated by the dark red dots. Now, it could be that a greater comfort among domestic banks to hold higher reserve balances, at least for now, is contributing to rates trading near IOER. In the Senior Financial Officer Survey, banks with higher reserve holdings since April indicated their increase was motivated by a desire to maintain a buffer against deposit outflows, as well as the absence of attractive risk-adjusted investment alternatives. As shown in figure 6, the growth in reserve balances has been particularly notable for US globally systemically important banks and large domestic banks that typically accumulate deposits. These banks collectively hold a much higher share of reserves than during the post-global financial crisis period, when foreign banking organizations absorbed a greater share of the reserve increase. As shown in figure 7, a second factor likely contributing to the higher level of rates relative to IOER than in 2014 is the significant increase in Treasury's net bill issuance this year to fund fiscal stimulus. Although T-bills are external to our stylized reserve demand curve I showed earlier, they're highly liquid and safe investment instruments, and an increase in the supply of bills tends to raise rates on a range of money market instruments that lenders consider to be substitutes. Indeed, analysis by New York Fed colleagues finds that controlling for changes in reserves, an increase of $1 trillion in the supply of short-term Treasury securities raises the spread of the effective federal funds rate relative to IOER by about 3 basis points. This helps explain some of the firmness in money market rates in recent months. So turning to my second question, Where do money market rates go from here? Reserves over the near term seem likely to continue to grow, though at a slower pace than during this past spring. I think the degree and rate of growth will largely depend on the path of asset purchases that the FOMC chooses. In the desk's November surveys of primary dealers and market participants, the median survey respondent expected net Treasury and agency MBS purchases to continue at the current pace through the end of 2021 before slowing in subsequent years. In addition, most market participants expect the Treasury to draw down the TGA over the medium term. Taken together, these measures could add significant reserves to the banking system. Even as aggregate reserve levels are expected to grow, many banks have suggested to us that they will increasingly take actions to limit their reserve growth. Some banks have indicated that compression in net interest margins and changes in their regulatory ratios associated with higher reserve levels are making additional reserve growth less attractive. Indeed, as shown in Figure 8, even as market participants broadly expect reserve levels to increase in coming months, the majority of senior financial officer survey respondents expected their own reserve levels to be stable or to decline. Many respondents reported they intend to let wholesale funding and FHLB advances run off and to lower the rates they offer on certain deposits. Now, these type of business changes take time to implement. So even if reserves were to stay near current levels, these actions could put downward pressure on market rates. Of course, reserves remain in the banking system unless they are absorbed by growth in another Federal Reserve liability or Federal Reserve assets decrease as the system is closed. Actions taken by banks to limit reserve growth can redistribute reserves to banks that have more capacity to absorb them. Eventually, though, money market rates will adjust until banks in aggregate demand the total amount of reserves being supplied. During the 2010 to 2014 period, as rates declined, foreign banking organizations absorbed a significant amount of reserves by taking on deposits from money market mutual funds. FBOs are natural borrowers in wholesale deposit markets and face lower balance sheet costs associated with reserve growth than domestic depository institutions. It's unclear, however, if these banks will be comfortable taking additional reserves in the current environment, or if other banks will step in to absorb reserve growth as rates fall. Going forward, it seems likely that some of the factors supporting rates this year will moderate or reverse. We'll continue to monitor money markets closely to assess evolving conditions. So this brings me to my final question: how will the Fed's tools work to maintain interest rate control? The Fed has two important tools that can help maintain control over the Fed funds rate and other short-term rates in this environment. IOER sets a benchmark against which banks evaluate short-term borrowing and lending opportunities, influencing other money market rates. And when rates fall below IOER, the overnight RRP maintains a firm floor on overnight rates by offering a broad range of money market investors an alternative risk-free investment. On occasion, the Fed has adjusted these administered rates to influence where the Fed funds rate falls within the target range. Since 2018, the Fed has made 4 such adjustments to IOER. And as shown in Figure 9, money market rates moved in line with each adjustment, demonstrating IOER's very strong influence. In instances where rates have drifted lower relative to IOER, the overnight RRP has maintained a strong floor. Since 2016, the effective federal funds rate has not traded below the target range, even on balance sheet reporting dates, when there can be strong downward pressure on rates. As shown in Figure 9, IOER is currently set at 10 basis points, well below the top of the target range. If undue downward pressure on rates were to emerge, the Fed could adjust IOER higher to lift overnight rates. Even if downward pressure persisted, the overnight RRP would maintain a strong floor by providing an alternative investment for money market participants, and if needed, by reducing the quantity of reserves held by the banking system. Of course, the Fed will respond to the environment as it evolves, and we stand ready to adjust the parameters of the overnight RRP and other tools as needed to ensure their efficacy. So in conclusion, the FOMC's implementation framework has been able to support actions taken to address the pandemic by smoothly accommodating a shift to much higher reserve levels. Given this significant increase in reserves, we might have expected money market rates to trade lower in the FOMC's target range relative to IOER than they have, similar to earlier experiences with abundant reserves. However, the factors that supported rates this year, high bill issuance, an elevated TGA, and domestic banks' apparent comfort holding higher reserves may moderate in 2021. As a result, rates could fall, reflecting an abundance of reserves. If this softness in rates emerges, it could help the financial system accommodate the growth in reserves by encouraging some banks to take on additional balances. Even if more persistent downward pressure on rates materializes, we're confident the Fed has tools to ensure effective interest rate control across a range of potential outcomes. Thank you.
Thank you very much. Can you hear me okay, Ms. Logan?
I can hear you well.
Thank you very much for that. Ms. Logan's been kind enough to open up to a little bit of Q&A. She has a very tight schedule, so I will do my best to edit as best as I can and try and get as many as we can in there. But we thank you for the extra time and for obviously taking the time to come with us today. If I might start out, and I'm just going to read these as they come in, if that's okay. So excuse my sometimes stumbling. As you noted in your remarks, the IOER and the overnight reverse repo rate are closer together than they were in previous period of abundant reserves, and they are also lower in the target range. Why is the setting of these rates different, so much so than before?
Well, the FOMC has two key tools I talked about, IOER and the overnight RRP. And both of those are used to maintain control in this environment. And they've made, or the Federal Reserve has made several adjustments to the rates on these tools to control the Fed funds rate and other overnight rates. And indeed, IOER and the overnight RRP rate are closer together than they were when reserves were last abundant. Now, at that time, the IOER rate was set at the top of the target range, while the rate on the overnight RRP was generally set around 5 basis points, but that did vary during its testing period. When we entered the March-April period, IOER had recently been lifted to 10 basis points above the bottom of the target range, with overnight RRP providing the floor at the bottom. And since March, these settings have maintained good rate control. The effective Fed funds rate is trading near IOER, as I talked about, well within the target range. Now, as we look ahead, I think if undue downward pressures emerge on rates, the FOMC could make further adjustments, for example, by raising the IOER rate to ensure good control over the Fed funds rate, as well as other overnight money market rates. Or additional adjustments to the tools could also be made to promote effective policy implementation and smooth market functioning.
Sorry, that was mine. First gremlin of the day. In your remarks, you talked about several reasons why money markets have been stable and close to IOER in recent months, and also noted potential changes that could lead to downward pressure. One factor you did not focus on was temporary changes in regulation. Could you talk about how those temporary changes in regulations have influenced banks' reserve management practices and money markets in general?
Well, earlier this year, as you noted, regulators announced a temporary change to the SLR, exempting Treasury, securities, and reserves from the calculation. The temporary change, I think, made sense to help banks accommodate the rapid increase in reserves and support bank lending. That said, I think the exemption didn't apply to the Tier 1 leverage ratio that binds many depository institutions. In my remarks, I noted that the largest U.S. banks have indeed absorbed a large share of reserves. When we conducted the Senior Financial Officer Survey this fall, the one that was released yesterday to better understand banks' management of their liabilities, we saw in the survey that respondents noted a need to match assets and liabilities due to large deposit inflows and a lack of available investment alternatives as the main factors behind their reserve growth. So I do think it's interesting that changes to the SLR was not highly rated as a driver for banks' increase in reserves. That said, I think the change certainly may have made it less costly, potentially supporting their comfort holding higher reserve levels. So I think, overall, I think it could be one factor supporting rates near IOER, but from the data we've collected and the discussions we've had with banks, it doesn't seem to be one of the primary factors that have really driven this tight relationship.
Thank you. Switching, if I could, more, let's say, to liquidity and credit facilities for a second. You talked on several occasions about the Fed's response to the pandemic and the important role of the 13.3 liquidity and credit facilities. How is the Fed's thinking about next steps, especially if market volatility increases as more states implement restrictions in response to COVID cases, and they tagged on an additional one? Does the expiration of these 13.3 facilities mean that they're retired? Can they be reinstated? If you could provide some color on that.
I think, even though the usage of the 13 facilities has been fairly limited so far, I really think they've been a critical component for supporting market functioning and the flow of credit to businesses and households. They provided important backstops that restored confidence and returned, I think, market participants to intermediating credit. Although a few of these facilities will expire at the end of the year, several will remain active, particularly those that provide backstop funding. So I think if market stress returns, it's important to note that the 13.3 facilities could, of course, be reactivated, as the Treasury Secretary noted in his recent letter. And if reactivated funds for these facilities could, come from Congress, this was the case with the CARES Act, or potentially from the ESF, which helped provided some initial funding for some of the funding facilities earlier this year, prior to the passage of the CARES Act. From an operational perspective, which is really what we're focused on, if directed to do so, we could reinstate the expiring facilities quickly if needed. Of course, the expertise and the experience and the vendor relationships it took to establish and operate the facilities will remain. I would note, though, that aside from the 13.3 facilities, we maintain a really strong toolkit to support market functioning and the flow of credit. Though they may not be perfect substitutes in all cases, the Federal Reserve certainly has a range of robust backstops. We can include the discount window, the repos that we're conducting for primary dealers, the temporary FEMA repo facility and swap lines with our foreign central bank counterparts. And in addition, of course, we continue to increase holdings in Treasury and agency MBS to support and sustain smooth market function and foster accommodative financial conditions.
Thank you. Switching maybe a little bit to more FOMC focused, if you don't mind, for a moment. One of the questions we've gotten also is in the November FOMC minutes, there was extensive discussion of asset purchases. What is your current assessment of market functioning in the Treasury and MBS markets? And if I could tag one extra part to that, are the purchases still needed to sustain such market functioning, in your opinion?
I mean, overall, I'd say that that market functioning in the Treasury and the agency MBS markets has improved substantially since the stresses that we saw in March and April. We see this in a wide range of market functioning indicators that we track. For example, bid-ask spreads in both Treasury and MBS markets are close to normal levels, and relative value relationships that we've been tracking very closely since that period have largely been restored. In the minutes to the November meeting, FOMC members suggested that in light of the improved market functioning conditions we've seen, the role of asset purchases have shifted more toward fostering accommodative financial conditions. Nonetheless, I think participants noted that asset purchases continue to sustain market functioning and provide insurance against risks that these market functioning risks might reemerge in markets. In terms of how the purchases could evolve from here, the committee had a robust discussion in November on asset purchases, and staff, of course, presented on different structures, and this was described in the minutes recently released. Our focus on the desk, of course, is to be prepared to execute the FOMC's directive for asset purchases. And for now, that means increasing net holdings at the current pace, which is about $80 billion per month in treasuries and $40 billion per month in MBS. And of course, being prepared to make further adjustments as needed to sustain smooth market functioning.
Two more, if that's okay with you. Let's see here. Okay, let's go to this. On asset purchases, yields are already quite low. I think that goes without saying. Do you think asset purchases are having an effect on the term premium at these low levels? And you know, in the end, why continue to conduct them at these already low levels, if you will?
And that's a great question. I mean, although yields are already quite low, as you note, I do think that asset purchases are currently fostering accommodative financial conditions and sustaining smooth market functioning, you know, like I talked about. I guess I'd highlight a couple points. You know, first, I'd note that yields are currently low, in part because of the ongoing expansion of Federal Reserve securities holdings. You know, so far we've absorbed you know, over $1 trillion in 10-year equivalent Treasury securities, and you know, I think around 750 billion or so in MBS securities. So, you know, when we increase our holdings, investors, you know, purchase other assets with similar risk characteristics, you know, overall putting downward pressures on yields generally. I guess in addition, I'd say that the asset prices are forward-looking, and yields, you know, that we're seeing today already reflect expectations for additional purchases. So ongoing purchases would continue to support accommodative financial conditions. The second point I'd make is that when thinking about how the purchases might have affected yields and term premiums, I think it's important to consider the counterfactual. You know, while we haven't seen a meaningful reduction in the term premium measures since prior to the pandemic, you know, those term premiums would likely have been substantially higher absent our purchases because of the historic increase in Treasury debt to fund the CARES Act, much of that in longer term securities. And then I guess finally, I'd just say that our purchases continue to sustain smooth market functioning. So while this is, you know, improved considerably since March, you know, risks from the pandemic, you know, haven't fully receded. So I think our ongoing purchases are helping ensure against any reemergence of that stress and supporting, you know, yields where they are.
Any chance I could ask two more, or should we leave it at one more?
I'd be happy to take one more.
Okay, here we go. What should market participants take away from the recent series of announcements on the LIBOR transition? I mean,
yesterday there were, you know, there were a number of important announcements on dollar LIBOR. Taken together, I think they propose a strong path to the end of dollar LIBOR and support the safety of the financial system more broadly. You know, there was certainly a lot to digest, but I think the key takeaway is that the proposed path, you know, encourages no new dollar LIBOR issuance after 2021, while allowing most of the legacy contracts to mature before dollar LIBOR stops. Regarding new dollar LIBOR issuance, the Fed, the FDIC, and OCC released supervisory guidance that discourages new use of dollar LIBOR as soon as practical, but importantly, no later than the end of 2021. Here they cited and highlighted safety and soundness risks. So any contracts written in 2021 should either utilize a reference rate other than LIBOR or have a robust fallback language that includes a clearly defined alternative reference rate after LIBOR's discontinuation. The announcements, I think, also help solve the challenges posed by legacy LIBOR contracts, you know, those issued before the end of 2021. You know, IBA announced plans that if adopted, would cease major dollar LIBOR tenors in mid-2023, and 2 of the little used ones at the end of 2021. So that mid-2023 cessation date will allow most legacy contracts time to mature. But the supervisory guidance, I think, makes clear that using LIBOR for new contracts after 2021 would create safety and soundness risks. And I think this is a key point. I mean, overall, I would just say that these announcements underscore the importance of continuing preparation for the end of dollar LIBOR. You know, fortunately, the Alternative Reference Rate Committee, a private sector group convened by the New York Fed and the board, and which many of the money marketeer members are participating in, has made significant progress in doing that. And just want to thank the members of that committee for their extensive efforts, and encourage everyone here to turn to the ARC's tools that they put together, their resources and best practices, preparing for the end of 2021.
Thank you for that, because I know that that's been certainly something that everybody's been paying very close attention to in general as we see 2021 coming, but especially as you mentioned over the recent announcements. I'm going to push the envelope and squeeze one more in, and then I promise that that'll be everything. But it's going to sort of piggyback on what you were talking about in terms of reforms, but now we're focusing more a little bit on the Treasury market. Can you talk a little bit more about your views on potential Treasury market reforms? Like, what do you see are maybe the key priorities? You know, a few bullet points here and there just to round out both sides of the equation, if you don't mind.
Well, I mean, I talked about this recently and noted that, you know, in March, we really saw an unprecedented demand for cash and broad-based selling of Treasury securities, and then these sales of Treasury securities really overwhelmed the ability of intermediaries to make markets, you know, on their normal terms. You know, while this was really an exceptional event, I do think it's critical that we study the March-April events, the cause, and see if there are ways to make the Treasury market more resilient. You know, there is a lot of work underway, both in the official sector and among industry groups. I know Governor Quarles has talked in particular and highlighted the FSB's planned work here, particularly with respect to non-bank financial intermediaries. I do think there's still just a tremendous amount to learn, but you know, I do think there have been a lot of great ideas that have been raised and considered. We had a conference here at the New York Fed virtually a few months ago, and a lot of ideas were raised there, and I've been sort of using that framing to really talk about some of these ideas, and I think we can really think about them in 3 main buckets. You know, those are around transparency, around ways to expand intermediation capacity, and the third is, you know, reducing the amplifying selling type pressures and structures that we saw in March and April. I mean, on the transparency front, there are initiatives underway. The Treasury Market Practices Group is looking at this issue, and interagency working group members that put on the conference have proposed some important ways to improve transparency in both the cash and the repo markets. On the intermediation capacity, several ideas have been raised. There have been proposals, you know, thinking about mandated central clearing, which could limit settlement risk or other adjustments to regulations to really increase flexibility of balance sheets of intermediaries. I think these are all really important ideas to be considered. And of course, there have been a number of ideas around you know, ways to address the amplifying selling pressures that we saw during that time. You know, and of course, many have raised thoughts about Federal Reserve tools and structures such as the FEMA repo facility that was temporarily put in place, or the repos that we're conducting, and whether more permanent structures like that would benefit the overall resiliency of the market. And I think all those ideas are things we're thinking about and doing further study on as we consider, you know, these various proposals to make the Treasury market really more resilient, and as we look ahead.
Well, in all honesty, that was wonderful. Thank you so much for taking the time. We really appreciate your insights, especially during this most unusual time. And
Thank
certainly speaking for myself, keep up the very good work. And to everyone watching, we thank you very much. We hope you found this as insightful as we did, and we look forward to our next event. Thank you very much, Ms. Logan.
Thank you so much for having me. I really appreciate it.
Yeah. Bye now.
Bye.